There's no city quite like Dubai. Once a vast sea of sand dunes, this glittering metropolis is now the epitome of opulence, boasting spectacular skyscrapers, extravagant shopping centers, and awe-inspiring landmarks. It's why many refer to Dubai as the city that defies all limits. However, this flattering moniker might soon be put to the test as financial currents threaten to erode the foundations of Dubai's prosperity and once again test the very boundaries the city appears to transcend, as it did in 2009. Simply put, is Dubai heading for another financial crisis? The shimmering skylines of Dubai, located in the United Arab Emirates, often serve to mask its problems. This iconic Middle Eastern city has a reputation as a global financial center and a shopper's paradise, but it's also widely known as a tax haven, a go-to destination for illicit money, and even a preferred hub for money laundering, usually through real estate. The darker side of this glamorous city already cost it dearly in the 2000s. After all, when a city earns the rep of a playground for the world's well-to-do, it's only a matter of time before the consequences of unbridled capitalism catch up. As this larger-than-life emirate faces a host of unprecedented issues in the 2020s, it's safe to say Dubai's glittering narrative of limitless prosperity is encountering a sobering reality check. But what does this reality check entail, and how much of it has to do with the same reasons that brought Dubai to its knees in 2009? There's only one way to find out. Stick with us till the end of the video. We'll delve into the heart of Dubai's economic challenges, exploring the factors contributing to a looming financial crisis. But we'll also let Dubai's bright lights shine a beacon on potential solutions to navigating those turbulent economic waters and avoiding a catastrophic 2009-style collapse. To understand whether Dubai's current economic situation has all the markings of the past financial crisis, we must look at these two scenarios comparatively. By examining the parallels between then and now, we'll be able to conclude whether Dubai is heading down the same road or whether it's learned enough to diverge from the pitfalls that led to its debt crisis. If you Google Dubai financial crisis of 2009, two words stand out: real estate. Since the real estate bubble played a pivotal role in the 2009 crisis, it shouldn't be surprising. We'll first examine Dubai's real estate market. What caused the market to crash was rapid and unsustainable growth in the real estate sector for several years. However, this construction frenzy was fueled by excessive borrowing, both by developers and investors, which led to an inflated real estate market. Then, the 2008 global financial crisis hit. The demand for property in Dubai plummeted. Projects were left incomplete, and property values nosedived by up to 40%. In other words, the real estate bubble burst, and it did so quite spectacularly. And given Dubai's dependence on real estate as a cornerstone of its economy, this crash had widespread repercussions on the entire economic ecosystem of the city. Fast forward to the 2020s, and Dubai is once again grappling with challenges in the real estate sector. There are three factors that raise concerns about the sustainability of the current real estate market in Dubai: skyrocketing property prices, an oversupply of housing units, and a slowdown in demand. All three of these echo the warning signs observed prior to the market crash. This time, however, the dynamics are shaped by a different set of circumstances. Most of these concerning factors can be explained by the influx of residents and investors driven by geopolitical tensions and unrest in various parts of the world. But there is one nationality that's driven this wave of migration and investment more than any other: the Russians. Russian money has undoubtedly helped fuel the sudden increase in property value in Dubai, as they've had no problem spending $10 or $15 million on a house. Although no public data is available, it's estimated that tens of thousands of Russians have moved to Dubai and the United Arab Emirates in general since the start of the war in Ukraine. As Russians increased among property buyers in Dubai, so did the prices of those properties. Let's take 2023 as an example. In the third quarter of that year, average residential property prices in Dubai grew by 19% on an annual basis. Villa prices alone jumped by 18%, which didn't stop buyers from purchasing them so much that their sales surpassed the 2014 highs. Similar trends were seen across other properties, as no price seemed too high for those eager to live in Dubai. In the first 9 months of 2023, Dubai recorded a staggering 116,116 new property transactions worth approximately $117 billion in total. So it shouldn't be surprising that, according to some estimates, Dubai alone was responsible for 4.8% of global property transactions by the total value in the first 9 months of 2023. It's also worth noting that these impressive figures aren't an isolated incident. but rather a continuation of the momentum that started in 2022. During that year, the Better Homes brokerage company recorded over 86,000 property transactions, up 61% compared to 2021. Compare the 2023 figures to those from 2022, and it's clear, once again, a lot is happening very quickly in the Dubai real estate market. But the skyrocketing property prices are concerning for reasons beyond a potential market crash. As Nasser Al-Sheikh, former general director of Dubai's finance department, put it, "There is a risk Dubai will become too expensive to live in." This isn't a concern just for the super wealthy, and it doesn't apply solely to purchasing. Even the average rents across Dubai were up almost 27% in 2023, despite several anti-price gouging protections. This increase meant a family living in an average apartment in Dubai could expect to pay over $67,600 a year in rent. To put that into perspective, this same amount could get you a luxurious apartment in one of the best buildings in Manhattan's top neighborhoods. In other words, it's only for the financially privileged. It also greatly impacts foreign workforce, which has played a pivotal role in Dubai's economic development. Expatriates who have long been drawn to Dubai for its economic opportunities may find that increasing expensive housing to be a deterrent. Without the dynamic labor force that powers this emirate, Dubai risks losing its competitive edge both culturally and economically. Keep in mind that Dubai's population is expected to surpass 4 million by 2026. But despite all those warnings, the construction in Dubai continues at a breakneck pace, and interest in these yet-to-be-built properties is also high, which is concerning. After all, speculative purchasing of such properties was one of the practices that helped fuel the 2009 financial crisis in Dubai. However, it's not all grim. Though some experts believe those factors could lead to another real estate bubble, others are hopeful the market will slow down gradually in 2024 as it comes to a limit in purchasing power, at least for the average customer. It's the elites that might be the problem. Their unbridled purchasing power is another worrying factor in a potentially new financial crisis in Dubai. You see, not all transactions going around Dubai are exactly clean and transparent. As we've mentioned, Dubai has a rep as a tax haven and a destination for illicit money flows. Given that the city has historically had an ask-no-questions approach to financial transactions, this should not be surprising. This lack of financial transparency was another major contributing factor to the 2009 crisis, as it allowed for unchecked speculative activities and excessive borrowing. Ironically, these somewhat shady activities have allowed Dubai to bolster its economic growth rapidly and become a global financial hub. So, can questionable activities actually help Dubai avoid a financial crisis? The answer is perhaps. That is, if these activities are allowed to continue in full force. You need to first understand how deeply entrenched shady practices are in Dubai's economic landscape. In 2020, Dubai was deemed one of the world's most secretive offshore jurisdictions by the Tax Justice Network. This advocacy group also ranked the United Arab Emirates, Dubai included, among the top 10 enablers of financial secrecy and corporate tax abuse in the world. Dubai's real estate market is especially a magnet for dirty money. After all, the entire city was built to attract wealthy foreign buyers, no matter where they get their money. Plus, according to Jody Vittori, an expert on illicit finance, real estate is unique in this aspect since you can actually live in and do business through your money laundering. The property developers and real estate agents in Dubai seemingly have no issues with this, as they adopted the same ask-no-questions approach to transactions. This has led them to accept huge amounts of money from various suspicious buyers. So it's no wonder the city has also attracted some of the world's most high-profile criminals, according to data obtained by the Center for Advanced Defense Studies, C4ADS, in 2018. Russian mobsters, Afghan warlords, European money launderers, Nigerian kleptocrats, African gold smugglers, and Iranian sanctions busters all call Dubai home. The Russian delegation features figures like Ruslan Baysarov, a businessman close to the Chechen dictator Ramzan Kadyrov, Alexander Borodai, the prime minister of the self-proclaimed Donetsk People's Republic, Roman Lyabikov, a U.S.-sanctioned lawmaker, and Dmitry Rybolovlev, a controversial oligarch. Among the Europeans, you'll find Daniel Kinahan, the U.S.-sanctioned alleged leader of an Irish criminal group involved in drug trafficking, Tibor Bokor, an executive director of a U.S.-sanctioned cryptocurrency exchange from the Czech Republic, and Miroslav Výbuch, a Slovak fugitive hiding from corruption charges. It's estimated that people and companies from or connected to Russia and Europe have invested as much as $31 billion in Dubai's housing market. This is only a fraction of the total $145 billion investment coming from foreign individuals and companies. By comparison, London is also considered a go-to hub for foreign property investors, yet the city only attracted $66 billion in investments in 2019. Then again, London isn't also known for its ask-no-questions approach to regulation and property ownership. Other notable figures include 7 individuals from all around the world sanctioned by the US or European countries. The same property registry, the C4ADS, shows that these individuals have links to 44 luxury properties in Dubai worth $28.2 million in total. The 7 individuals in question are Wael Abdul Karim from Syria, sanctioned for conflict financing; Hussein Eduardo Figueroa Gomez from Mexico, sanctioned for drug trafficking; Kambiz Mahmoud Rostamian from Iran, sanctioned for nuclear proliferation; Altaf Kanani from Pakistan, sanctioned for terror financing; Hussein Purnashband from Iran, sanctioned for nuclear proliferation; Kamel Mohammed Alhaz from Lebanon, sanctioned for terror financing; and Rami Makhlouf from Syria, sanctioned for grand corruption. To make matters worse, these individuals were also linked to an additional 27 properties worth approximately $78.8 million through their expanded commercial networks. Of course, their love for Dubai is also aided by the fact that the UAE doesn't have an extradition treaty with the United States or the European Union. Naturally, not all financial, business, and real estate transactions in Dubai are associated with illegal activity, but there is no denying the massive impact this activity has on Dubai's prosperity. The wealth coming in from crime and corruption has helped fuel the city's booming real estate market and make the elites even richer. Interestingly, despite a huge chunk of Dubai's finances coming from underground financial transactions and organized criminal activities, the city's managed to maintain a positive international reputation. That's why almost 1/3 of the world's top 500 companies in terms of revenue have their regional headquarters in Dubai, and also why Dubai attracted an estimated $12.8 billion in foreign direct investment capital in 2022. But you can't work with that kind of money without drawing scrutiny. Dubai's reputation took a massive hit in March 2022 when the Financial Action Task Force, or FATF, the global financial crime watchdog, placed the United Arab Emirates on its so-called Grey List. The FATF Grey List, officially known as Jurisdictions Under Increased Monitoring, is reserved for countries identified as having strategic deficiencies in their anti-money laundering and counter-terrorist financing regimes. Initially, the UAE didn't seem so concerned. After all, the FATF has been calling for fundamental and major improvements in the country for 2 years. Ahmed Al-Sayed, the Minister of State, even told Reuters that the country's economy is resilient and diverse, and that the grey listing would have a generally low impact on sectors like banking and real estate. However, it appears that the UAE soon realized the risks of being grey listed by the FATF, which include trouble obtaining global finance and higher transaction costs. So it started working on addressing the concerns raised by the organization to be removed from the list. Their work has apparently paid off. They're poised to be removed from the list in February 2024, almost 2 years after being placed on it. This removal points to their substantial progress in areas like facilitating money laundering investigations and imposing sanctions on non-compliance at financial institutions. If all goes well during the FATF's on-site visit, the UAE can bid farewell to the grey list. But at what cost? Remember that a huge part of Dubai's attractiveness as a global financial hub lies in its willingness to engage in shady transactions with shady characters. After all, a substantial portion of the city's economic activities hinges on these two facets. Take these away, and Dubai and the UAE risk experiencing a significant transformation in its economic landscape, which could usher in a new financial crisis. Then there's Dubai's debt. The city has never truly recovered from the debts incurred by the 2009 crisis, despite a $20 billion bailout from Abu Dhabi, the UAE's capital, a $10 billion loan, and another $10 billion in bonds to cushion the blow. As a further courtesy, Abu Dhabi agreed to refinance the debt and extend the repayment in 2014. The financial burden was so huge it took Dubai almost 14 years to begin repayment, which started in 2023. By this time, Dubai's GRE debt rose to $60 billion, or about 50% of Dubai's gross domestic product. In 2023, however, Dubai managed to lower the debt to 25% of its GDP. This included the $5.5 billion repayment to Abu Dhabi and another $23 billion in debt restructuring. This was achieved a year early, as the government set out to bring its debt to 1/4 of Dubai's GDP by the end of 2024. Though this might seem promising, remember it comes at the heels of an economic boom caused by ambitious development projects and international investments. We've already covered why Dubai might need to reduce its reliance on both of these aspects in the future, which means this impressive debt reduction pace is unlikely to continue. But couldn't Dubai just turn to another source of revenue to sustain its economic recovery? If you know anything about the United Arab Emirates, oil is probably the first thing to come to mind. After all, the country consistently ranks among the top 10 largest oil producers in the world. Unfortunately, Dubai has largely diversified away from oil over the past few decades, as the emirate primarily focused on investing in its social and business sectors. That's why it shouldn't be surprising that oil revenue now contributes less than 1% to Dubai's GDP, even though it once contributed 50%. But even if this number were higher, Dubai would still struggle, as the crude oil prices have plummeted and continue to do so due to global economic tensions and a slowing demand. For comparison, Brent crude oil once fetched over $100 a barrel, while more recently it went down to $72 in December 2023. The slowing demand for oil also affects Dubai's trade, as the city used to be a trading hub in the Persian Gulf, immensely benefiting from the flow of international trade. So oil, out of the question. But what about those social and business sectors Dubai heavily invested in? Could they help reduce Dubai's debt and avoid another financial crisis? Well, not quite. Several of Dubai's crucial sectors have been seeing declining revenue for years. This downward trend was present even before the COVID-19 pandemic, which further exacerbated the economic challenges. For instance, Dubai's economy grew at a rate of 1.94% in 2018, the slowest pace since the 2009 financial crisis. In that same year, it was recorded that the local stock market, the Dubai Financial Market General Index, was trading at 2,683, which is almost down 50% from its 2014 value of 5,302. All in all, it's clear Dubai will have a hard time paying off its remaining debt. Given how alarming the oversupplied real estate market, the oil price plunge, and the rest of the factors we discussed before are, it shouldn't be surprising many economists fear Dubai defaulting on its debt. As one prominent economist puts it, this is not the first time markets have fretted about a Dubai default, but this time it's serious. So let's say Dubai runs out of options to resolve its debt issues. Could anyone else step in? And by anyone else, we primarily refer to the neighboring Abu Dhabi. Of course, we are well aware Dubai still owes almost $15 billion to this emirate from the last time Abu Dhabi came to the rescue, but let's just explore this possibility. After all, Abu Dhabi has always been a key regional economic player with substantial financial resources. While this still rings true, remember that the decline in oil prices hit Abu Dhabi as well, even worse than Dubai. Still, the entire emirate remains somewhat financially stable, thanks to a 7.7% growth in non-oil GDP at the end of 2023. Plus, let's not forget Abu Dhabi's sovereign wealth fund, the Abu Dhabi Investment Authority, is estimated to be worth $853 billion. This could, of course, pay off Dubai's debts a dozen times over. But the mere fact that Dubai had to start paying off its debt to Abu Dhabi should signal the emirate's unwillingness to help Dubai any further. Though some might see this as concerning in regard to the economic stability of the UAE, it's clear Abu Dhabi probably expects Dubai to take responsibility for its financial obligations and work toward fiscal sustainability. But can Dubai actually do it on its own? There are figures that say the answer might be yes. In January 2023, Dubai launched a 10-year economic plan, the Dubai Economic Agenda, D33, aiming to establish Dubai as one of the top 3 global cities in which to invest, live, and work. To do so, Dubai's government has pledged to double the size of its economy in the next decade. Given everything you've heard about said economy in this video, this might come as a shock. But the first data coming from Dubai shows that this might be feasible after all. Supported by a 10.3% growth in transportation and storage sectors, Dubai's economy grew by 2.8% in the first quarter of 2023, a little after the D33 strategy was implemented. Other notable growth figures include a 5.6% growth in the accommodation and food services sector. If you remember, none of these sectors were mentioned in the video, which means the Dubai government still has some tricks up its sleeves when it comes to a self-bailout. The tourism sector also continues to flourish, with 2023 setting the record for the number of international visitors. In the first 6 months of 2023, 8.55 million foreigners visited Dubai, which even surpassed the pre-pandemic record of 8.36 million in the first 6 months of 2019. Coincidentally, tourism is one of the pillars of Dubai's proposed economic model that's supposed to help the emirate avoid another financial crisis. To this end, Dubai plans to extend the length of its public beaches from 13 to 65 miles by 2040. In addition, there are plans to revive the artificial Palm Jebel Ali Island, which was abandoned following the 2009 financial crisis. Of course, all these plans cost money, which means they might also lead to Dubai's government repeating the same mistakes from the past, including excessive borrowing. However, many analysts believe that this isn't possible, as Dubai has learned its lesson and set up a debt management office in 2022 to keep its debts in check. Though most of Dubai's plans require significant investments, they're expected to generate liquidity and help pay off the Emirates' debts in the long run. Of course, the world is closely watching what's happening in Dubai and the UAE in general, as the strategic importance of this region cannot be understated. After all, the UAE is one of the US's and the UK's key trading partners in the region. That's why Dubai's ability to navigate financial challenges can have far-reaching implications both for the region and the world. What do you make of these financial challenges? Do you believe that Dubai's over-reliance on real estate transactions, foreign investments, and shady financial activities has booked it a one-way ticket to financial ruin? Or do you think the recent figures coming from the Emirate indicate a potential for recovery? Sound off in the comment section below, as we're eager to see how you perceive the economic future of Dubai and, in turn, the region. Now go ahead and check out this video, or maybe this one instead.